The Boston Fed president says rates are likely to be on hold for longer. Japan's central bank governor says a one-sided weak yen move is undesirable. Taiwan's exports are weaker than expected. And the Bank of England is expected to hold rates tonight. It's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, looks at the ability and timelines for Asian central banks to cut rates following the recent push out of expectations for the Fed's rate cut track.
We have really truncated the number of rate cuts this year for the economies that will cut, which is also a small number. And for the rest, we've pushed it out to next year.
But first, in 5 and 5 with ANZ, markets largely treaded water overnight as a lack of major data releases saw traders focus on commentary from policymakers. US Treasury yields were up between 1 and 3 basis points. That nudged the US dollar index up 0.15%. On the rates front, Boston Fed President Susan Collins said rates would likely need to stay on hold for longer than previously thought, and that it would take longer for inflation to return to 2%. Meanwhile, in currency markets, Japan's central bank governor said it was important for currencies to move stably and reflect fundamentals. He was commenting on supporting the yen. Kazuo Ueda said abrupt and one-sided weak yen moves raised uncertainty and were negative for the Japan economy. He continued to decline to comment on whether Japan had intervened in recent weeks, but said it was natural to consider action if the currency moves affected price trends. The US dollar was trading up 0.5% against the yen at 155.57 yen at 5 a.m. Sydney-Melbourne time. The Aussie dollar down 0.3% at 65.78 US cents, and the Kiwi dollar up 0.03% at 60.0 US cents. Number 2, the Bank of England's Monetary Policy Committee meets tonight. The consensus is for rates to be left on hold at 5.25%. Here's ANZ Group Chief Economist Richard Yetzinger.
I think the Bank of England will continue to try and avoid playing too much into the market's kind of aggression for clearer signals about when the easing will come. We still expect the Bank of England to ease in Q3, so I don't think they'll be too dovish, but there'll be enough there to suggest the next move is a cut.
Number 3, it's decision day for Malaysia's central bank as well. ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, says Bank Negara is expected to hold.
They've signalled quite clearly in the past that the current policy conditions are appropriate. Now, one change that is happening is that Malaysia is finally getting serious about recalibrating or rationalizing fuel subsidies, and should that happen, that would sort of raise inflation. And we need to see if the statement itself makes any reference to how policy would react in such a scenario.
Number 4, Q1 GDP for the Philippines is also due today. The consensus is for 5.9% annual growth. That's up from 5.5% in the previous quarter. Sanjay says the annual rate should have a 6 in front of it.
Specifically, we're looking at 6.3%, and 2 things that will support it. One is that consumption should improve now, given that there's been a slight pullback in inflation, and that should sort of improve the purchasing power of households. And the second is that we've seen imports have fallen quite a bit. So a lot of sort of drag that was there from net exports should start to fade.
Number 5, Taiwan's exports rose less than expected in April with annual growth of 4.3%. However, a continued surge in demand for AI-related products increased exports to the US by 81.6% from a year ago. Exports to mainland China, though, were down 1.1%. The next set of regional trade data this week will be from China, where Richard says it should show a continued upswing.
Certainly, the boom in AI, demand for chips, electronics, that tech cycle story has been helping the regional dynamic in trade, particularly North Asia, while parts of South Asia like Indonesia continue to get support on the trade side through things like commodity prices. And what it all adds up to is that Asia, this Fed tightening cycle, has been much, much more resilient than we've seen in some of the past few tightening cycles. And a key part of that dynamic is that the trade cycle has stayed pretty solid.
Richard Yetzinger there. Now, in our bonus deep dive interview, ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, says the pushing out of expectations for when the Fed will start cutting has led to a recalibration of when Asian central banks might be able to do the same.
The main issue here was that the recalibration of the US Fed's funds forecast and really pushing out the bulk of the rate cuts into next year was the most important catalyst in terms of our recalibration. And effectively what we've seen is that moving ahead of the Fed obviously invites a lot of currency weakness, and that can potentially flow through inflation. So in terms of the recalibration exercise, we have really truncated the number of rate cuts this year for the economies that will cut, which is also a small number. And for the rest, we've pushed it out to next year. Now, one thing, we've still maintained that the total Fed funds rate cutting cycle is worth 200 basis points. And over the course of 24 and 25, we still expect central banks to cut. It's just that they've delayed it.
So just in terms of those policy rate revisions, you've looked at the different economies and assessed them by looking at their growth, inflation, and external positions. Can you talk about how you've done that assessment?
Yes, so it's really based on three factors. The first is what sort of improvement are we seeing in the balance of payments situation, and is it durable? I.e., is the current account and FDI improving to a point that they're driving the balance of payments? The second is the distance from inflation targets. So every central bank in Asia will have a certain tolerance level, and really depending on how far you are from it, will also decide how much currency weakness you can tolerate. And the third and very important reason is how badly do you need rate cuts in the region? Which economy needs it most? And on that basis, we came up with sort of two economies that were clearly in need of lower rates, which is South Korea and Thailand. India was the unique case over here in the sense that we do think that real rates would have risen quite sharply if the RBI doesn't cut. And secondly, perhaps we underestimate the growth potential of India. So that was the first category in which we've got one rate cut penciled in each year. Then you look at Malaysia, Philippines, and Indonesia, where there's been significant currency weakness, and Philippines inflationary pressures are still lingering, and that really means they won't be able to cut this year at all. A case in point is that Indonesia, to curb off rupiah weakness, has actually raised rates. And that really leaves you with Taiwan, which is still facing inflationary pressures, and Vietnam, where rates were cut way ahead of other central banks, and they really don't have much flexibility at this stage.
So in terms of the risks to these forecasts, it seems a lot still depends on the US Fed.
Yes, that is correct. And one of the things that we pointed out was that we have our forecast, and then we also have what the market is pricing in. And the market is a lot less generous in terms of the rate cuts. So if that situation arises, we will have to recalibrate our forecasts again. And the second point of note over here is that the sort of growth momentum in Asia is not terrible right now. So that, and the strength of the US economy is supporting Asian exports, etc. So if that situation stays, the need to cut rates will also diminish.
Sanjay Mathur there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, May the 9th. Catch you tomorrow with reaction to the Bank of England's rate decision tonight. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.